Hello there, it's David here from Dingle Lane. Now, many businesses' accounts are now starting to really show the signs of the COVID crisis in the form of bad debts. Getting tax relief at the earliest possible opportunity can help to reduce the pain somewhat for you. So what can you claim for and when? Well, firstly, of course, the thing to look at is your VAT position. VAT due on sales is normally accounted for on the return covering the date of the issue of your sales invoice. If a customer fails to pay, that leaves you out of pocket. Fortunately, if that's the case for you, then of course you can reclaim your VAT. The following conditions have to be met for that to be the case. Firstly, the VAT has to have been included on the earlier return, of course. The debt in question has to be more than 6 months old. And finally, the invoice has to be written off as a bad debt in your business accounts. Assuming is this the case, you just adjust your VAT return by adding the VAT element of the bad debt into your input tax element in box 4. Of course, bad debt relief can be obtained automatically if you use the cash accounting scheme. Normally, the VAT system means that you pay the revenue, the VAT, on any invoice you issue, whether or not it's been paid. But under cash accounting, you defer handing over any VAT until you've actually been paid. If your turnover is under 1.35 million, then cash accounting scheme's available to you, and in most cases, it makes an awful lot of sense to use. But if you're on the normal scheme, then certainly if you do reclaim the VAT using the bad debt relief rules, but subsequently then receive a payment from that customer, just treat the money received as VAT inclusive, repay the relevant bad debt relief or HMRC on the return that covers the payment date. But the thing is, what an awful lot of people forget at that point, particularly if you start moving into other accounting years, is that deductions can also be claimed for income and corporation tax relief, subject to conditions. So what do you need to know? Well, once a sale has been made, of course, it is treated as income as far as your accounts are concerned for your business, for income and corporation tax purposes, whether or not you've actually been paid yet or not. So you will be liable to income tax or corporation tax based on that sale the moment the invoice is raised, or at least in terms of the accounts that invoice sits in. But to compensate, you can claim that a debt that's gone bad, claim that as a business expense, so reducing your taxable profit. The amount claimable is, of course, the unpaid sum, excluding any VAT. Now, unless you identify bad debts and claim a deduction for them in your accounts, it means that you will have ended up paying tax on sales for which you've received no money. And of course, that's not great as a business practice, not great for cash flow. And you'll have noticed from my videos that cash flow is absolutely at the heart of the kind of services that I encourage my customers to use from us, and right at the heart of all your business planning systems. You're handing money over to the taxman for nothing. And we've seen businesses that have been out of pocket for years because they haven't made a proper review of their debtors at the end of their financial year, or indeed on a regular basis at all. So what action can you take? Well, the initial hurdle is, of course, to identify the debts that you can claim for. You aren't allowed to make just a general provision for bad debts, make a general estimate, even when you have a lot of very low transactions, and low value transactions rather, which you know will result in some bad debts. Each and every single debt has to be considered and reviewed in order for it to be allowable as an expense from a tax point of view if it turns bad. Equally, you can't just say, nah, it's a bad debt, write it off, thank you very much. You actually have to make a reasonable and proportionate attempt to recover the money that you've owed. If it's a small amount, of course, say 25 quid, 30 quid, well, the taxman won't expect you to have sent dozens of chasing letters, spent lots of time on the phone, got a debt collection agent involved, and so on and so forth. But equally, where fairly large sums are involved, they will have expected you to follow the debt collection process cycle right the way through to having exhausted all the reasonable avenues that you might be expected to take, right up to the point of taking court action if appropriate. But apart from that, it's pretty much your judgment call. Thing is, hindsight can also be quite useful. Even when a debt appears to be a good debt at the end of your accounting period, the taxman does allow you to claim for relief when it subsequently turns bad. So to maximise the relief that you get from your bad debts, make sure that before you finalise your accounts and sign them off at the end of every accounting period, make sure that you do a final review of all the trade debts that are actually included in your accounts. Now, of course, for limited companies, that could be 6, 8, 8.5 months later down the line. You'll certainly have some extra information at that point, and it may well be that some of your accounts from 8-9 months ago have actually gone bad, at which point let's get them written off in those accounts so that it's a chance for you to get that tax relief in straight away. If you're sure that a debt isn't going to be paid, you can claim it as an expense in your accounts. And you can decide whether a debt is bad right up to the point that the annual accounts are being finalised. So always make that review before signing them off. And it can make quite a big difference. I mean, for instance, if you've identified £5,000 worth of doubtful debts, this can save you £1,000 in tax. Quite a significant amount in the context of the current cash flow issues that many businesses are facing. Okay, there's something to think about. Thanks for your time. Enjoy the rest of your week. This is David from Dingle Lane. Nanu nanu.